Hello, this is Sandra Cho with Pointwealth Capital Management, and today we are going to be talking about fixed and fixed index annuities. I just wanted to mention that fixed annuities are one of the most plain vanilla conservative investments that you can get. They're actually fairly simple as far as investments go. You get a fixed interest rate, which is why it's called fixed annuity. And that interest rate can vary. So for example, right now it's a low interest rate environment, fairly low, but interest rates are coming up as of this recording. Right now, one of the interest rates, for example, that we can get is a 3-year at 3.4% or a 5-year at close to 4%. Now, interest rates do depend on the product, the company, and the timing of when you get that annuity. But that interest rate is fixed and it compounds daily. That's one of the nice things about a fixed annuity. Generally, don't expect a lot of statements because it does not fluctuate. So in all probability, you're going to get one statement a year. Some people worry about that, but it's only because this is just a conservative investment and you're not going to see fluctuation. One thing about fixed annuities is that it is not FDIC insured, even though it is guaranteed by the issuer. So it's principal protected, but not by the FDIC. So for example, if you get a fixed annuity by AIG, that annuity is going to be guaranteed by AIG. If AIG goes under, then you might be in a bit of trouble. However, unlike other investments where there is not a guarantee, fixed annuities are not only guaranteed by the issuer, but they have a second layer called the State Guarantee Fund for fixed annuities. Every state is different, but in the state of California, the State Guarantee Fund will guarantee you 80% up to $250,000. So one strategy that I use for some conservative clients is I might ladder fixed annuities. So I might put some money in a 3-year fixed annuity, some in a 5-year fixed annuity, and some in a 7-year fixed annuity. And that way, every 2 years, some money is maturing from a fixed annuity and they have access to it. Now, most fixed annuities allow you to take out some money without any penalty at all. Generally, that amount is about 10%. Some carriers allow you to take out more, say for example, 15%. Another thing that you want to be aware of with fixed annuities is that it doesn't necessarily go by calendar year. For example, if you invest in a fixed annuity and let's say you put the money in May 1st, well, that annuity anniversary date is going to be May 1st. You then would wait 1 full year, and that would be that first year. So let's say you go into a 5-year fixed annuity, you have to stay in that annuity for 5 years in order to not get a penalty when you take everything out. That said, if you remember that you can usually take out 10% every year, then you do have access to some of that money before that 5-year term is up. You also want to be aware that the devil is in the details with fixed annuities. Make sure you understand the contract, make sure that you understand if there is a penalty-free withdrawal, meaning you can take out money every year. Also, can you take out that 10% or 15% or whatever it is within that first year? Some allow you to. Or do you have to wait 1 full year before you can even take out a withdrawal? One thing about fixed annuities is that because it is guaranteed by the issuer, aka the life insurance company, you want to make sure that that company is strong. Now, while credit agencies and credit ratings aren't the end-all be-all, one good place to start is to make sure that that company has a good credit rating. Another very important detail about fixed annuities is that whether you have a free withdrawal or not, you cannot take out money from a fixed annuity, or any annuity for that matter, until you are 59 and a half without getting a 10% federal withholding penalty and being taxed at ordinary income tax rates. So this type of investment is generally good for people who want to set aside this money for retirement specifically, or for older people that are near or over 59 and a half. Also be aware the tax consequences of having an annuity. So if you put non-qualified or non-IRA money into an annuity and that money grows and grows and grows, and you haven't paid taxes on that growth, when you take out that money, you will be paying taxes on that growth first. The IRS makes sure about that. So make sure you understand the terms and the conditions of your annuity. Please be aware, I'm not a tax advisor. I don't give tax advice, and I highly recommend you to speak to your CPA or tax advisor. Thank you so much. Have a great day.